Okay. Welcome back to the very last chapter of accounting here, which is chapter 13, the closing process. Okay. All right. The purpose of the last section is going to be teaching you the last 6 steps of the accounting cycle. Okay. So when we were dealing with the accounting cycle, right, we were practicing the first 4 steps, right? Collecting our source documents, right? Analyzing and sorting the information, the data that we collected, right? We practiced journalizing those transactions, and we practiced posting them to through the general ledger, right? We've been practicing these 4 steps, and we have been practicing completing trial balances. But here in this chapter, right, when we finally sum up and complete our entire month's worth of Coffee Cafe, right, we've been practicing the 4 steps right now. We're going to go ahead and proceed to the rest of the scenario, right? And when we reach the end of the accounting period, this is where we're going to start initiating the last 6 steps of the accounting cycle, right? Starting with preparing with the unadjusted trial balance, okay? So again, we talked about the unadjusted trial balance where we test our account balances, right? The ultimate goal here is to test to see that we have not made any mistakes here and there. So again, once we completely do all of the journals and transfer them all to our account balances, we're going to create one last trial balance, and it's going to be called the unadjusted trial balance, okay? So what we're going to do is we're going to take a list of all the accounts that we used, and we're going to test whether our total debits match our total credits at the end of the accounting period, okay? Once we have successfully matched our debits with our credits, that will definitely ensure the accuracy of our accounting, okay? So once we complete our trial balance, right, then the next step is step 6, and which is to do your adjustment entries, and then step 7, which is doing the adjusted trial balance. So what are the adjustment entries, okay? So adjustment entries are things that you have to wrap up at the end of the accounting period. So a good example of that is going to be things like supplies expense, right? We know that periodic inventory is an adjustment entry, right? Because we don't adjust our inventory or do our inventory conversion until the end of the accounting period, right? Or so that's why it's called an adjustment entry, okay? So a periodic inventory, depreciation is an adjustment, okay? Supplies expense, right, where we purchase supplies, right? We need to adjust to see how much we actually have currently on hand available, and basically get rid of the supplies that we used. And then, of course, we got to do cost of materials, and bad debt is going to be one of them. So I did mention all of these. So these are all going to be examples of adjustment entries, okay? Now, of course, the list goes on a little beyond this, just because since we're doing a scenario, I already mapped out all of the adjustments that we need to be making for the Coffee Cafe. So in this case, this is just examples of what adjustment entries that we have already seen in class, right? We have seen periodic inventory, we have seen depreciation, we have seen bad debt expense, okay? So here, right, the example here is office supplies and bad debt expense, depreciation, okay? Then we talked about so once you've done your adjustment entries, right, you're going to post it to your journal, right? And then you're going to post those adjustments to your ledger. Okay, so then once again, you're going to complete the adjusted trial balance. Okay, this is to ensure that when you made your adjustment entries, because when we make our adjustment entries, right, we're moving from one account to another. You want to make sure that when you transfer those debits and you correctly place them in their correct spots in their credits, or we do the credits and we debit them in the correct spot. So in this case, this is to ensure that after we completed our adjustment entries, right, that we properly placed them into our ledger and we properly was able to successfully move our debits to our credits or our credits to our debits, right? By listing out all of our accounts, including with the new accounts, right? With the adjustment accounts, and making sure that they do pan out evenly with our debits equaling our total credits. Okay. Once we've completed that, that's where we're going to move on to our financial statements. Okay. Very, very important that you know that the financial statements must go in an order. Okay, it has to go in a complete order. So first things first is you're always going to complete the income statement first. Okay, so what does the income statement do? It tests for profitability. Okay, how do we do that? Well, we first have to start about how we generate our income, right? What is our main core of operations when generating income? So that means our sales, right, is our main core operating income, right? That's how we make money, is through our sales, right? So you're going to calculate your total sales, okay? Then the next thing is you're going to counter them against your cost of goods sold, because this is directly correlated to the inventory itself, right? When we sell our inventory, right? This is where we also, it's directly related to the sales, right? Because when we sell our products, right, it's taking out from our inventory, and we use that to represent our cost of goods sold, which is an expense count for us to get rid of the inventory, right? So once we do that, that's where we solve for a gross profit. Okay, gross profit, meaning this is what we've earned after countering our cost of goods sold, right? Once you've done that, then you're going to take your gross profit, right? And you're going to subtract out every single operating expense that you occurred for that current accounting period, okay? Because at the end of the day, once we've done that, right, this is going to determine, did the amount of money that we've earned end up being more than what we spent to operate our business. Now I'm going to give you a heads up here. Most cases, usually, okay, when you start a business, typically the first couple of months, even the first year, okay, if you're starting from a business from the ground up, you're most likely going to have a loss for the first year. Why? Because, again, right, we talked about this in Coffee Cafes, because you're constantly making all of these expenses ahead of time to set up your store, right? You have to incur all of these expenses first, because that's how you're able to open up your store and be able to generate the income to basically reimburse all of those costs that you have incurred. So most cases, you're most likely going to get a net loss, especially for a small business that's starting from the ground up, okay? So in this case, that's just that there. But if you end up getting a positive number, that means you actually gained a net profit. You generated more income that covered all of your expenses, okay? Now, like I mentioned before, right, sometimes when you start a small business from the ground up, usually you'll tend to have more expenses that occur because you have to buy this, you have to buy that. So sometimes when you get a negative number at the bottom here, that just means you took a loss, okay? You have a net loss. So what do I do with a net loss or a net profit? Okay? Now, if it's a net loss, what you have to do is you got to take that number and you have to take it out of your equity, which is the next financial worksheet, okay? But when you have a net profit, you do have two choices, right? You can either pocket the profit, meaning you could take the profit right through an owner's withdrawal, or you can reinvest it into your company. Now, for a small business that owes a lot of money, your best bet is that you should reinvest that money back into your company. So then, again, the more you keep reinvesting back into your company, right, the more value you have to your company, but the more ability you're able to pay off your liabilities and so on and so forth. And it also shows that your business is doing well, right? If you can increase the value, right? Or you could just pocket that profit, right? Because you're the owner, right? So that means the owner can take the money at any given time, because whatever profits that the company earns, that means that's what the owner can also take as well, right? So in this case, as a small business, right, especially when you're starting from like a brand new company, best rule of thumb is you should definitely reinvest your money into the company, because again, the more you reinvest into your company, right, that means you can also expand your company because you have the money to do so. Okay, so in this case, right, this is the next financial worksheet that we're going to be doing, is the statement of owner's equity, right? This is how we determine how we change the value of the company, right? First, we got to start off by what was the original investment, or what did you start out the company with? Now, in this case, right, the scenario says that we started out with $2,000, okay? That was our equity, okay? Now, this case is when you have a lump sum of money and you invest it into your company. That is your beginning. Now, if you didn't have any to begin with, then you would have zero equity, okay? So again, a net profit will increase your equity, okay? A net loss would decrease your equity, okay? And we talked about this, right? Capital contributions increase, right? If you add more money to the company, it will increase the value of your company. But if you take away money from your company, it will decrease the value of your equity, okay? So once we've done that, right, then we're going to solve for the difference, okay, between the net income, net loss, capital contributions, and owner's draw. We're going to find the difference between there, right? And then now, if it's a positive number, you're going to add those two numbers together. If it's a negative number, then you're straightforward, right? You're going to subtract that number. So then at the end of the accounting period, you're going to have a new value in your owner's equity, okay? So here, right, I made a profit, I reinvest into my company, so now it is now worth $23.09 okay? So then, right, the next one is going to be completing the balance sheet, right, which is to test the accounting equation, right? Your total assets equal your liabilities plus your equity. So in this case, once you solved your owner's equity, right, that is going to be a given component that's going to be transferred into your balance sheet, right? So all you're really solving for is you're testing to see if your total assets equal your total liabilities because equity is already given to you, right? Because you solved it from the previous worksheet, okay? So now do you see why it's so important that these financial worksheets go in this particular order, right? You need to solve for a net income or a net loss first to revalue your equity. Once you find that value of your equity, that's where you're going to plug it into your equation. So you already have one of the components to the equation. All you need to do is you need to list out all your assets and list out all your liabilities and then plug it into your equation. Do they equal? And if they do equal, then your accounts are balanced. Okay? You balance the accounting equation, right? So once you've done this, right, next, the last step is going to be completing the statement of cash flows, right? Which, once again, I mentioned this earlier, right? It's a combination between your income statement and your balance sheet, okay? And we break it up into 3 categories, right? Operating expenses, operating activities, investing activities, and financing activities, okay? So what do you mean by it's a combination between the two? Now, if you remember what the purpose of the statement of cash flows does is it actually takes a look at how much money you're actually earning, okay? So through the net income, right? But how much of that is actually did you receive cash for? So that is where we're going to be entering how much actual cash that we actually receive. So in this case, right, when we go through the statement of cash flows, you are constantly asking yourself this question. Did we receive cash for it or do we not have cash for it? Okay? So in this case, right, because what we're determining is how much money flowed into the company and how much flowed out of the company. So your operating activities is going to be broken down by your current and other assets and your current liabilities, okay? While you're investing, right? Investing activities is purchasing fixed assets. So it's going to be your fixed assets. And then financing is going to be taking any loans out, right? A liability, long-term loans, okay? And then, of course, anything that you've done for equity, whether you put your original investment in there, right? That is financing your company, right? Or if you took money away from your company, right? That's also you taking your investment out. So in this case, once we've done that, what you're going to be determining is the amount of cash that you started out with in the company going to result in the ending balance in your cash in your balance sheet. Okay, so this is where we're going to be plugging in our numbers, and the beauty of accounting is everything should match. Okay, so in this case, that is the statement of cash flows. Okay, we'll talk more in depth with it when we actually dive into it. Then, after we've done our financial statements, we can now proceed to the actual closing the books, okay, which is step 9. How do we close our books? It's pretty straightforward, right? We are going to take our temporary accounts, right, which is our revenues and our expenses, right? So here we bring back chapter 2 here, right? Learning about the difference between permanent and temporary accounts, right? Our temporary accounts close at the end of the accounting period, right? That's what we determined what permanent and temporary means. So our temporary accounts, which is our income and our expenses, right? How do we close out these accounts? It's straightforward, right? When we talk about closing out an account, we're talking about zeroing out the account, okay? Now, since, right, for a revenue, right, it normally has a credit balance. How do I bring that credit balance back down to 0? I would have to debit the account for the same amount for it to bring my account balance to 0. That is going to be determining how I close out my revenues, okay? So same thing with expenses, right? Except expenses, they normally have a debit balance. So you would just do the opposite. So in this case, I would be crediting my expenses to 0 the amount. And where am I zeroing these accounts out to? I'm going to be having a account called income summary, okay? In business, right, we understand as income summary as the same thing as retained earnings, right? For a corporation, they like to use retained earnings, okay? It's a placeholder for you to have the total amount of income that you've earned, right? So in this case, right, that's what the income summary does. It's where you're going to close out all of your revenues to the income summary, and you're closing out all of your expenses to the income summary, okay? And then once you've done that, then you're going to take your income summary and you're going to close that out to your equity, okay? Depending, right, if you have a debit balance in your income summary, then you're going to credit the income summary and debit the equity. So that means you're going to have a loss at that point, right? But if you have a credit in your income summary, you need to debit your income summary and credit your equity, right? Because you're going to close out your income summary to your equity, right? That is you reinvesting the money back into your company, right? And then you could choose to either do an owner's withdrawal there or not. Okay? So most importantly, once you transfer your income summary to your equity, that is essentially either increasing the value or decreasing the value of your equity. Okay? And of course, anything else that affects equity, you're also going to complete as well. Okay? Then, last but not least, step 10 is going to be completing the post-closing trial balance. So once again, because once you've journalized, right, that you're zeroing out all the accounts, you're going to pop them into your ledger, okay? And at the end of the day, your equity should match your statement of owner's equity. Okay? And then all the value, if that is true, then the post closing trial balance should be very fairly easy to create. Okay? So in this case, you're just going to test to make sure that your debits are equal to your credits and make sure that your equity is actually what the value of your new equity that you calculated in your statement of equity. Okay? And that is it for Chapter 13. So again, Chapter 13, the closing process is going to be determined based on the last 6 steps of the accounting cycle, okay? So we talked about the last 6 steps, and these are things what you have to do. So trial balances is you're going to list out every single account, and you're going to test to make sure your debits and credits match. So again, we know where this comes from, right? This comes directly from the general ledger, okay? Down here is in the train of events when you're closing out your temporary accounts, right? You're going to debit all your revenues to income summary, and you're going to credit all your expenses to income summary, and then you're going to either debit or credit your income summary to your equity. Okay? And these are the exact order of the financial statements and what completes the steps to be able to create each financial statement. And then we talked about the adjustment entries. Okay? So, any questions in regards to Chapter 13?